buying life insurance can seem like a very daunting task, especially because there's so many different people saying so many different things. We have some advisors saying that you should buy term and invest the difference. We have other advisors saying that whole life insurance or infinite banking or be your own bank is the best solution. We have other people that are saying mortgage life insurance is a good solution or something else is a good solution, that it can seem very daunting to try and find what's the best option for you and your family. And in this video, I'm going to go over everything that you need to know about buying life insurance in Canada. And by the end of it, you'll know exactly where to buy it from, what the best product is for you, and which ones are definitely not the right product for you. What is up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped thousands of Canadians find the right life insurance coverage at the right price. If that sounds interesting to you, I'll put a link in the description and you can check it out. But without further ado, let's get right into the video. Okay, so the first thing I want to go over is the 3 different types of life insurance in Canada. So first we have term life insurance, and then we have permanent life insurance. But with that, there's 2 different kinds. There's universal life insurance and there's whole life insurance. So first, let's just talk about term life insurance. Term life insurance is the easiest type of life insurance to understand. You have a specific term, whether that's a term 10, a term 20, or a term 30, and you have that life insurance for that period of time. And during that time, those premiums are going to be fixed in price. So if you pick a term 20, your premiums are going to be fixed for 20 years. If you pick a term 30, et cetera, et cetera. Now, this is the cheapest type of life insurance, and usually most carriers will have these 2 things that go along with term life insurance. That is renewability and convertibility. So what does that mean? Well, that means, let's start with the first one, renewability. If you have, let's say, a term 10, you get it for 10 years for $1 million or $500,000. And at the end of the term, maybe you have some health conditions that prevent you from going out to the market and getting another policy. Maybe you need it for another 10 years. Maybe your needs have changed at that point. Maybe you need it for another 20 years. Who knows? The renewability option lets you go back to the carrier and say, hey, I want to renew it for another 10 years. I have this heart condition now or health condition. I can't go on the market and get another policy, but I want to renew it for another 10 years. Most carriers in Canada will let you do that. So you can renew it for exactly whatever the term was. If it was a 10, it'll renew for 10. If it was a term 20, it'll renew for 20. Now, the other option that most term carriers have is a convertibility function. So a convertibility function is where, again, maybe near the end of your term, maybe halfway through your term, you decide, you know what, I do actually want some type of permanent life insurance coverage. Well, no problem. You can actually convert your term life insurance policy into a permanent life insurance policy with that carrier. And now the benefit of this, again, is without evidence of insurability. So if some type of heart condition or health condition or something else came up that prevented you from going to another carrier, you always have that option to convert it with most carriers in Canada into a permanent life insurance option. Now, term life insurance is really just to cover you for a specific period of time. So you bought a house, you got married, you have kids, you have financial responsibilities. If something were to happen to you, your loved ones would be financially impacted. And so term life insurance is meant to cover that specific period. So usually this is when you're at your most vulnerable during your lifetime and you have a lot of debt and you have a lot of responsibilities. Now, this is usually from somewhere between age 30 and age 60, where of course we're getting married, we're having children, et cetera, et cetera. However, in theory, we want to pay for this insurance for a specific period of time, but then we want to cancel it. We don't want to pay for this for the rest of our life. It's used to cover us for a specific period of time. Hopefully by age 55, 60, 65, our kids will be out of the house. Our mortgage hopefully will be paid off at that point, and we'll have some investments in the bank where, of course, if we did pass away, there would be an impact on the family, but there wouldn't be a financial impact on the family. So term life insurance is meant to cover you for a specific period of time, and then it's meant to be canceled and gotten rid of. It's not meant to last until the end. So you're not meant to renew your life insurance coverage 65 to 75 to 85 in the hopes that you'll pass away. It's priced in a way that it's meant to be canceled when you don't need it anymore, which is usually around that age 60 to 65. Permanent life insurance, on the other hand, is meant to cover you until the end. Now, there's 2 different types here, and I'm going to explain how they work. So we have universal life insurance and whole life insurance. I'm not going to go incredibly into detail about how these work. I've made other videos on the channel about this, but I will just kind of explain the basics of how it works. So universal life insurance is a bit of a more complicated product, but with that, you get flexibility. So in a nutshell, there's 2 different components with universal life insurance. You have the cost of insurance, and then you have this investment fund, and these are separated. And so the cost of insurance, there's a few different ways you can structure it. You can do what's known as yearly renewable term, where it increases every single year, or you can do what's known as level cost, meaning it's going to be the exact same cost until you die. And you set this up at the beginning, and you can change it as you move forward, but typically you're going to try and structure it in a way that the cost of insurance eventually is paid for by the returns on the investment fund, because this is the other part of the equation where you're contributing putting money into this investment fund, it works very similar to other investments where of course it can go up, but it also can go down. And in theory, what we're trying to do is we're trying to have the returns from this fund pay for the cost of insurance and then hopefully not have to pay for the coverage anymore. And whenever we pass away, our family will receive that death benefit. Now, universal life insurance has definitely been getting a bad reputation in the industry. There was a recent investigation done by the FSRA, which is essentially the government body in Ontario that regulates insurance. And they went after several different MLMs who were selling a lot of universal life insurance policies. And we're going to explain that a little bit later here in this video. However, all you need to know about universal life insurance is it can be a good option for savvy people that are looking for a little bit more of a complicated product. They're okay with having some potential downside and also having some potential upside. It's a little bit more complicated of a permanent life insurance option. It can be better in some circumstances just because of the flexibility and the simplicity of it. But I find in 99% of the cases where I find clients that have this type of policy, it's usually been set up incorrectly. And not only is it not better, but it's drastically worse than if they would have just invested their money in some type of investment or gotten a corresponding whole life insurance product. Now, whole life insurance, on the other hand, is a much more simpler option than universal life insurance. However, with that simplicity, it does get a little bit more expensive, but what are you getting with all that simplicity? So one of the number one benefits of whole life insurance is it's guaranteed. You have a guaranteed payment schedule, you have guaranteed cash surrender values that are within it, and you have guaranteed death benefits. So you're essentially paying for the insurance company to take all of that stress and that liability off of your plate. You say, I don't care, I'd rather just have it guaranteed. I don't want to worry if my investment fund is doing good or bad, if it's going to pay for the premium, am I going to lose all my money? I just want to know, can I pay for a period of time and get a death benefit at the end? And whole life insurance essentially is that product. So you can have different payment periods where you pay for a certain number of years and then the policy is paid off, meaning you no longer pay the premiums, but you still get the death benefit. So typically that could be a 10-year period or a 20-year period. They do have some known as life pay where you essentially can pay for the duration of your lifetime, but there's many different ways that you can structure a whole life insurance policy. Now, along with that whole life insurance policy, there is that cash surrender value, which is essentially the equity within your policy that you can take a loan against if you want to. However, the question comes up all the time with all of my clients and everyone that reaches out to me. They say, should I get term life insurance or permanent life insurance? That is, I think, one of the biggest questions that clients have when purchasing life insurance, because you have a couple different thought processes here. Right? You have, well, if I buy term life insurance and then I don't pass away, did I just waste all that money? Should I just buy permanent life insurance? Because then at least I know that I'm going to get that death benefit one day and maybe my premiums aren't wasted. And I would say this, as I've ran all the numbers and calculations on this, term life insurance is not a waste of money. It would be the same as if you think about car insurance, for example. You don't pay your car insurance every single month and you think to yourself, man, I've never gotten into an accident. That sucks. I'm wasting my premiums. I wish I could get into a really bad car accident and sue and get some money back. You would never think that. Same with home insurance. You would never, pay for home insurance and think, dang, my house never burnt down and I never claimed on my home insurance. What a waste of money. Term life insurance is the same thing. You're paying to protect yourself for a specific period of time and hopefully you don't die. I mean, you don't want to use that benefit, right? Hopefully you live until you're 85, 90, 95 and you don't pass away in those early years. But of course, it sounds good in theory to say, hey, well, I'm going to die one day. I might as well put it towards some type of permanent life insurance policy. And I've ran all the numbers and I've looked at all the illustrations, and 99% of the time, if you just bought a term life insurance policy and took the excess that you would have put into a permanent life insurance policy and just put it into an investment such as, your TFSA or your RRSP, and you invested it at, a modest, let's say 6%, you're always going to be ahead with that buy term invest the difference strategy and just put it into some type of investment. And there's way less strings attached. Now, I will say this, however, for the minority of Canadians that are the high income earners, maybe they're business owners or just high income earners, and they're in a very high marginal tax bracket, and they've already maxed out other traditional vehicles such as your RSP or your TFSA, it could be a good idea because now we're not comparing it to a TFSA, we're comparing that strategy to a non-registered fund, which of course we know is taxed very high. That's where this strategy could be applicable. So in a nutshell, who is term life insurance right for? The majority of Canadians who probably haven't maxed out their RSP or TFSA, they're looking for coverage for their family and they're going to use it for a specific period of time. Who is permanent life insurance right for? Well, this is really for those people that are looking for a permanent life insurance. Maybe you know for a fact you're going to have a lot of taxes upon death. You want to help with estate planning. Maybe you have a disabled child and you know you're going to have to leave something to them when you pass away, whether that's in 10 years or 50 years. And then the third part is that wealthy or high income earner or business owner that is looking for some tax strategies upon death and maybe some type of alternative investment during their lifetime. Now, one of the other big questions that I get a lot is, do I even need life insurance? And a lot of people will come to me and they'll say, okay, yeah, do I need life insurance? Maybe I'm 20, 25, 30 years old. And I'll tell them this: the need for life insurance doesn't happen at a certain age. It happens when people are financially dependent upon you. So you could be 18 years old and you could have just bought a house with your partner. Maybe you have kids at this point, and if you were to pass away, they would be financially impacted. Well, you need life insurance. But maybe you could also be 35 years old, have no dependents, you're not married, you don't have anyone, again, that's financially dependent on you. Maybe in this case, you don't need life insurance. So the need for life insurance doesn't come at a specific age, it comes at specific circumstances. Buying a house with a partner, getting married, having children, having aging parents that are financially dependent upon you. All of these things are circumstances in when you might need to buy life insurance. Now, another one of the common questions that comes up is, should I buy life insurance when I'm young to lock in the rates? Now, here's the thing. I hear this from advisors all the time. They'll start saying that, oh, you should buy life insurance when you're young, because what happens if you get a health concern when you're older and you can't get preferential rates? And of course, you want to get these good rates when you're young. Let's lock them in. Now, one of these things is true, and I'm going to explain it here. If you do have some type of health condition that comes to you later on in life, maybe you're 20 right now and you wait till 25 or 30, and that's when you have a family and that's when you have kids or whatever it is that you need life insurance. Maybe you do have some type of health concern that comes up and you are unable to get a life insurance policy. Now, this one is absolutely true. Depending on what type of health condition it is, you might be able to get life insurance from what's known as a no medical life insurance company or a simplified issue life insurance company. But typically these rates are not going to be as preferential. But you know yourself best. And if you're a healthy person, you take care of yourself, you know, you're eating right and you're exercising, I would say it's probably not your biggest concern. And if you don't have any history of any type of adverse health conditions in the family, it's probably not something that I would consider. However, if you did foresee yourself getting some type of health concern because maybe you're not taking care of yourself, or you do have a family history of some type of health concern, this could be a good idea to possibly buy a life insurance policy at a younger age. However, the second one of quote unquote locking in your rates, this one's a little bit of a lie. If you actually look at the life insurance rates for, let's say, an average male 20-year-old and an average male 30-year-old, they're almost identical. In fact, life insurance prices will actually go down as you get older from 20 till 30, especially for men, but also for females, because in those early years, the mortality risk is actually higher. You're younger, you're doing a lot more stupider things, and there is a risk that you might pass away. Of course, there's still a risk later on in life, but there's more a risk in your young years because people are doing, you know, things they do when they're young. Obviously, there's still risk. Usually when you get to your late 20s and early 30s, you settled into life a lot more, and the chance of you dying is a little bit less. So actually, the prices of a 20-year-old are probably going to be more expensive than the prices for a 28 or 29-year-old, or almost identical. So there's no point buying a life insurance policy just for the price to lock it in, because it's going to be the exact same price when you get to 30 as it is right now at 20. Now, the last thing that I'll talk about in this video is which life insurance company is the best company to go with. And now here's the thing. In Canada, all the insurance companies are regulated by the same regulations. All the contracts are generally the same. So depending on what type of product you're going for, you probably just want to try and find the cheapest option. It's not like they say with other things, you know, you get what you pay for. With life insurance, that's not true. All the contracts are generally the same. So instead of trying to find, you know, one specific company, that's better than the other, just try and find the cheapest company, especially for term life insurance. Now, with that being said, there are a few different companies that might have specific perks. You know, maybe they have like a smoker perk where they give you 2 years to quit smoking, and in that time, they'll give you a non-smoking rate. Maybe some are more preferential if you do, you know, maybe something like mountain sports where you can't qualify with a traditional company. Maybe you have some other health concerns where one company is going to be better than the other company. But in general, if you're just a standard, regular, average Canadian, you're going to try and find the cheapest company, and they're going to be the exact same contract as the most expensive company. Now, with all that being said, I hope that I was able to shed a little bit of light about life insurance in Canada. If you guys have any questions, just drop them below. And as always, if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.